Thank you so much for participating in the HDFC Bank's third quarter conference call. Let me also introduce two of my colleagues, Jimmy Tata, who's our Chief Risk Officer, and Srinivas Vaidyanathan, who's joined us on the 1st of December. He's a career city banker with 27 years of experience, mostly in countries in Singapore, Hong Kong, and New York. He comes in with a wealth of experience, and he should be a great asset to the institution. Let me first hand over this mic to Srini to talk about the key aspects of the third quarter financials.
Okay. Thank you, Sashi. Good evening, all. We can first start with the income statement for the quarter. The bank's total income for the quarter ended 31st December 2018 at rupees 30,811.3 crore, grew by 26% from 24,450.4 crore for the quarter ended December 31, 2017. Net revenues for the quarter amounted to rupees 17,497.8 crore. Net interest income for the quarter was 12,576.8 crore, registering a growth of 21.9%. The core net interest margin for the quarter was 4.3%. Other income for the quarter amounted to rupees 4,921. Fees and commission income, constituting 91.8% of the other income, grew by 27% to reach 3,646.8 crore. Breakup of other income, broadly, the commission grew by 27%, as I said before. FX derivatives came down a little, negative 6.7. Profit and loss on investments up by 82.7%. Recoveries and miscellaneous up by 29.3% for a total of 27.2%. On the expenses side, operating expenses for the quarter were 6,719.3 crores, an increase of 17.2% over the corresponding quarter of the previous year. Core cost to income ratio for the quarter ended 31st December 2018 was 39.5% as against 41.2% for the corresponding quarter ended December 31, 2017. Total provisions were 2,211.5 crore for the current quarter, as against 1,351.4 crore for the corresponding quarter in the previous year. Profit before tax for the quarter ended 31st December 2018 was up 20.7% to rupees 8,566.9 crore. Net profit for the quarter grew by 20.3% to 5,585.9 crore. Some key balance sheet items. The balance sheet size at December 31st, 2018 was 11,68,556 crore as against 9,49,079 crore as of December 31, 2017. Total deposits as of December 31, 2018 amounted to 8,52,502 crores, an increase of 22% over December 31, 2017. CASA deposits grew at 13%, with savings account deposits at 2,35,179 crore and current account deposits at 1,11,905 crore. Time deposit at 5,05,417 crore grew by 29% over previous year, resulting in CASA deposits comprising 40.7% of the total deposits as of December 31, 2018. Total advances as of December 31, 2018 were 7,80,951 crore. Domestic advances grew by 24.1% over December 31, 2017. As per regulatory Basel II segment classification, domestic retail loans grew by 24% and domestic wholesale loans grew by 24.1%. The domestic loan mix as per Basel II classification between retail versus wholesale was 55% to 45%. Overseas advances constituted 3% of total advances. Moving on to results for the 9 months ended 31st December 2018, the bank earned a total income of rupees 85,393.5 crore as against rupees 69,912 crore in the corresponding period of the previous year. Net revenues grew to 47,908.4 crore as against rupees 40,428.9 crore. Net profit for the half year ended 31st December 2018 was up 19.7% at 15,193 crore over the corresponding half-year ended last year. With regards to capital adequacy, the total capital adequacy ratio as per Basel III guidelines stood at 17.3% as against a regulatory requirement of 11.025%, of which Tier 1 capital adequacy ratio was 15.8%. As of December 31, 2018, the bank's distribution network was at 4,963 banking outlets and 13,160 ATM across 2,727 cities and towns. 53% of the branches are in semi-urban and rural areas. Number of employees increased to 96,425 as of December 31, 2018. On the asset quality front, gross NPAs were 1.38% as against 1.33% as of September 30, 2018 and 1.29% as of December 31, 2017. The coverage ratio stood at 70%. Net NPAs were 0.4% as on December 31, 2018. The bank held floating provisions of Rs 1,451 crore as of December 31, 2018. Total provisions, which comprises specific provisions, general provisions, and floating provisions, were 115% of gross non-performing loans as of December 31, 2018. That's the prepared notes I had. Thank you.
Happy to take on question and answers.
Thank you very much. We will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Maruk Ajania from IDFC. Please go ahead.
Hi. On slippages, could you quantify those, and also if you could give some segment-wise flavor on how much was agri, retail, and corporate if there was any. And also just on the agri piece, given that more waivers have been announced, will the slippages in agri continue to rise over the next 3 to 4 quarters? And also if you could give us some color on the write-off policy on agri loans.
Right. Thank you. First is the slippage ratio. The gross slippage ratio is about 2.04%. At ex-agri, it's about 1.7%. So that's the slippage ratio. In terms of the asset quality during the quarter, let's split into 4 parts. One is the corporate, one is the SME, the third is agri, and the fourth is retail. I think I'll just combine both the slippages and also the credit cost, so that more or less, if you really look at it, largely the charge to ENR is more or less stable at about the 0.8 to 0.9%. And when you really look into the elements of it, in fact, barring agri, most of it has been stable. If not, in certain cases, we have been actually coming down. So agri, we have seen a bit of a spurt in terms of the charge to ENR. And that is something that all of us know why it is so. Since you've just alluded to the fact that a lot of new states went into elections in the recent past, the 3 states of Rajasthan, Madhya Pradesh, and Chhattisgarh have announced waivers, and we also know that there's impending general elections coming in. The bank has taken slightly more conservative stance and have provided contingent provisions to the extent of around 335 crores. A large part of this primarily on account of being towards anticipated losses arising out of such waivers going forward in the agri portfolio. So we do anticipate and we do expect a bit of a spike in in the agri portfolios. It's a combination of the fact that already 5 states have, 3 states have announced, 2 other states have announced but have not put the guidelines in place. There are certain states of Kerala, Maharashtra, where there is some natural calamities. The prices of onions have actually come down sharply. So we may not see too much of an impact in the March quarter, but certainly from June quarter onwards, there could be a bit of a rise in NPLs. And that is exactly why the bank has taken a precautionary measure of providing conservatively contingent provisions during the quarter.
Could you quantify the slippage, actually the total slippage number, 2.04?
2.0, yeah. You want to know the in absolute terms? 2.07, it's
yes,
about 3999 so 4,000 crores.
Okay, thanks. And just the write-off policy on agri?
Write-off policy on agri, we, Jimmy,
historically, hi, this is Jimmy. Historically, we have not been writing off NPAs in agriculture. And given the retail nature that these products have, there will probably prospectively be some policy coming in which we would be introducing, which may involve some levels of write-offs. But historically, there has not been a write-off in that portfolio.
So because, it's only in the last, since of June of 2017 that we started to see spike in the NPLs because of the farm loan waivers. And we realize that these are certain things, these are all timing differences where we will see a bit of a spike in or spurt in the NPLs. It should sort of, over a period of time, all these things should come back, which is the reason why we have not sort of exercised write-off policy, as Jimmy has just mentioned.
But going forward, given that there are instances and repeat instances that keep occurring in these products, we may be introducing a policy because the recoverability, our policies always are based on recoverability of the advance, and for that reason, we may be introducing.
Thank you so much.
Thank you. Next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. So I would like to understand, are there any segments on the asset side where we have slowed down cautiously in terms of growth? And what are the reasons for the same, if there are any? And also, are there any segments where incrementally we see a challenge in gaining market share and growth in those segments would reflect more of growth in line with the industry growth rate?
Frankly, from a sectoral perspective, there's not been any significant change to our outlook, and our growth has been pretty much stable across sectors and across segments. Having said that, we do see a bit of a slowdown in the two-wheeler and the four-wheeler segment, primarily not because of we had to slow down, but the underlying sales have actually started to come off significantly. So we are probably slightly faster than that, but yes, relative to the prior quarters, or you will see a bit of a tepid growth in auto loans. Two-wheeler, maybe you'll start to see that going forward. But yes, that is, these are one of the areas where we are seeing a bit of a slowdown in the underlying sales, and hence it could impact on the financing part of it as well. The third area where we are seeing a bit of a, or we did see a bit of a slowdown until probably recently, is the loan against property segment. Not because of anything. I think our portfolio has been pretty very stable, and if at all, even better than what we had in the past. But we were seeing pricing pretty much below acceptable threshold levels. And I think we see certain corrections happening in the recent past with the NBFCs staying away from market. I think we've got the pricing back. So that hopefully will correct itself going forward.
Okay. And anything on the business banking side, because YTD growth is only 10%. So just want to get some color on that.
So there are two parts to it. The business banking, there's a large ticket and a small ticket. Small ticket is what we call the emerging enterprises group within our own division. That actually is very granular, and that's been growing pretty stable and very well, even both from a business perspective and even from a credit perspective. It's been pretty stable. The areas where we are not growing is on account of the agri-commodity, which is where we are, the areas where we are not seeing is on account of the agri-commodity, and that is where we did have a bit of a concern last year, which we had been mentioning in the previous calls as well. There was a bit of a spurt in the gross NPL numbers in business banking around December of last year, etc. And that's fortunately corrections have happened, and it's now pretty much stable now. We probably should see that particular portfolio getting cleaned up in due course.
Sure. And thanks, sir. Lastly, on the core fee income side, any color, like Q-on-Q, we have seen around 11% growth. So what were the key drivers of that?
Sorry, come again?
On the core fee income side, sequentially, the growth is 11%, year-on-year 27%. So what were the drivers of the...
on the fee income?
Yes.
On the fee income. Okay. The primary driver in fee income, both year-on-year and sequential, primarily has been two areas. One is the payment business itself. Payment business has seen pretty much buoyant numbers in terms of actual spends, both on the acquiring volumes and issuance volumes ever since demonetization, and that's continued to surprise us in terms of the trend continuing even this year. It surprised me as well. So that's been giving us a fair amount of both the issuance income. And also what has been happening is there has been now better spreads. In fact, acquiring business is normally a loss leader. Losses have been steadily coming down as well. So the combination of higher spends on the issuance side and hence higher incomes plus higher volumes on the acquiring side plus lower losses on the acquiring business has helped us to have a decent amount of growth in the fees both on a year-on-year basis and sequential basis as well. The second element which has sort of really contributed to our fee growth is on the cash management side. I think we have re-examined all our transactions and our transaction costing, and that has sort of helped us to start getting in a bit of a lift in our wholesale fees as well.
Sure. Thanks a lot, sir.
Thank you. Next question is from the line of Pranav Gupta from Birla Sun Life Insurance. Please go ahead.
Hello. Yeah, am I audible?
Yes, you are. Barely, but...
Yeah. So I have two questions. Firstly, on the deposit side, we've seen a strong growth in term deposits. So could you give us some color on whether these are more retail and granular or whether this is more towards the wholesale term side?
So this has been the bank's stated policy to start focusing on granular deposits right from January of 2018. If you really go to our websites and card rates, we have been one of the pioneers to push up the retail granular rates, especially the 1 year, around the 1 year, 2 year bucket. We have been focusing on that, and we realized that it's a simple ask that sometimes we never used to ask our customers to put our deposits in us. People assume that we never offer good rates on the FD side. So I think that has also sort of helped us right from January, because that's been the stated ALCO policy to be always liquid and more liquid than required. So if you really look at the press release, I think Srini would have alluded to it, and the same, where we have been having a liquidity coverage ratio of almost about 122%, which is far higher than the requirements. While this will have a bit of a drag in the margins, the bank and the ALCO was pretty much had accepted this and probably said that we are happy to live with a bit of a drag. And this is something that if you have heard Paresh in the previous calls, he would have mentioned that as well. So we continue to follow our deposit mobilization strategy. In fact, that is quite embedded in our business model itself. In fact, in the wholesale side, one of the key metrics that we use is to the self-funding ratio. Each one has deposits, whether it is CASA or even time deposits. So, but bulk of the 29% growth in time deposits now in this quarter is primarily retail in nature. In fact, one of the reasons why you see the accretion for savings account during the quarter is not too much is because you have seen a bit of a dip in people putting in FDs from their savings account.
All right.
This is something that we are comfortable with because notwithstanding the fact that we are seeing the yields have also been moving up, so as long as our margins are maintained or even slightly better, I think we are not too worried about a lower CASA ratio.
All right. My question is not relating to the lower CASA ratios, more towards, some banks, hearing some banks outbidding others in terms of pricing for term. So that's where the question was coming from. Anyway, secondly, I would like to, if you could just throw some light on the performance of your subsidiary, HDB, how their growth has been, how their margins have been trending.
So we did mention to you in the second quarter the margins would take a bit of a knock because I think the cost of funds across the system has gone up, especially for NBFCs. So the margin has come down from the 7.2 levels to about the 6.7 levels. The growth rate in the AUM or advances has gone up by about 26%. It's now about 50,000 crores. And his gross NPL levels are about 2%, 2.07%, which is similar to what he had declared December of last year.
All right, great.
Yeah.
Thank you so much.
Thank you.
Thank you. We take the next question from the line of Monica Agarwal from Bernstein. Please go ahead.
Hello. Yeah. So my question is on the IT spend. So can you throw some color on how much of our total expenditure would be towards IT expenditure?
So we do have a lot of metrics in this. One of the key metrics that we track is what is the percentage of net revenues that I have IT spends. It's not just capital, but all my running expenses as well. That's about roughly around the 3 to 4%.
Okay, so 3 to 4% of the net revenue, you're saying?
Yeah.
Okay. And I see this quarter we have added around 138 branches. So can you, can you just throw some light on where have we added these branches and what's the strategy going forward?
No, we had always mentioned that, we have the appetite to add about 150, 200 branches every year. So, what happens is, normally, when you plan, then you have to go for the right sites, then have the find the right properties, have the right legal documents in place, and then you start, once the legal agreements are in place, then you start the work, the renovation, etc. Frankly, the actual work involved is just about very short. It's the initial process which takes a long time. So invariably, we have seen, barring a few years, otherwise, normally the branch expansion has been always rear-ended towards the third and fourth quarter of the year. So this is just one similar kind of an event wherein we have just, people have pushed more branches during this quarter. It's still roughly about incrementally between semi-urban and urban. I think 50-50, that's where it is.
Okay. That's all from my side. Thank you.
Thank you. Next question is from the line of Ojas Kecha from Axis Capital. Please go ahead.
Yeah, hi.
So my question is specific to CASA growth. I mean, when we look at it, the CASA growth is lagging the aggregate deposits growth for last 5 consecutive quarters. Leading to a dip in CASA share, which is now back to pre-demon levels. I just wanted to, get your understanding. Are we facing, and is there a rise in competition intensity, or what is the bank strategy to shore up the, CASA levels?
See, I'm happy you're saying 5 quarters, because if you see, this is exactly when we started to push up our time deposit strategy as well. There are 4 key things that we measure. One is the gross credits coming into the accounts. 2 is how much of these debits go into paying off our EMIs. 3 is how much of the debits go into moving into our own time deposits or distribution products such as mutual funds and LI and insurance, because we distribute that. And last but not least is where it goes to other banks. So the concern would be if the last one, if I see an increasing trend out there. The reality that is happening is that we have seen over the last 5 quarters the second piece where people have been dipping into their savings account, which we are pretty much okay with, because obviously at some point in time, once the savings and the salary flows will continue to catch up with us. We have seen the increase or enhanced sales efforts by our frontline staff to ask customers about keeping deposits, because we are better priced in terms of the deposits as we speak on the retail side. So right from Jan of 2018 till now, I think we have seen a huge amount of deposit growth, especially in the time deposit, which is out of the so-called CASA. And that is the reason why we are seeing not such a great growth rates or absolute amount of accretion that you otherwise would have seen. We are not too concerned about that, because 2 things. Number 1 is we track to ensure that the gross credits, the debits going into paying my EMIs and card. 3, the debits getting into FDs and other third-party products. These are actually increasing within the bank. The one which is going outside the bank has been pretty much stable. If not, it did come down in the previous quarter and sort of slightly inched up during this quarter. But having said that, we are not overtly concerned about that. The second one is it will have cost implication as long as we have been able to pass on the cost of higher cost of funds because of the high time deposits into better and have a better yields as well, and hence maintain our margins. We are all right with that.
Okay, this helps. I'm done. Thanks.
Thank you. Next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, good evening. A couple of questions. On this agri portfolio, right? Since kind of Jimmy mentioned that we will now going forward will have perhaps a write-off policy as well. I'm just wondering, does it what will be the strategy of doing agri going forward? Because in itself, I think the IRR of that portfolio would have been a little lower. There's not a lot you can actually charge on the top line, right? So if you can elaborate, what kind of customers you would perhaps be looking at, ticket sizes, et cetera, et cetera. So that would be my first question. Second would be on this acquiring business. You mentioned that the losses have been coming up. So just want to understand what is actually driving that. And finally, you did allude to, this agri-commodity business where, NPLs have been coming off. So would that mean that, between the manufacturing MSME versus trading MSME, both the segments are now doing much better than in the past? Those will be my 3 questions. Thanks.
Okay, let Jimmy answer the credit part portion of it, and then I'll answer the payments portion of it.
Yeah. Agriculture firstly is largely directed lending, so there is a requirement to do it. The return, however, is not
It's pretty healthy, actually.
You are alluding to. Actually, the rates are quite good.
These are not the kind of rates that one probably a public sector will get. These are rates that are in the decent anywhere between 10 and 12%.
Sorry, let me just kind of stop you there. I mean, these are farm loans, right? Pure farm loans.
Yeah.
And basically what you're saying is even within that there is a huge amount of disparity between lending rates of PSUs and let's say HDFC Bank.
Yeah.
And would that be dependent on the ticket sizes as well, or the type of farmer you're talking about? Large farm holdings, for example.
The biggest differentiator in the rates of PSU and private banks would be on account of the subsidies receipt. So that would probably account for the biggest differential. The loans are typically given based on product programs that are in the bank and reviewed periodically, not even so rather frequently of late. The loans are extended to farmers from very small to large. It depends on the permissible lending allowed as per the scale of finance. So all these kind of regulatory parameters enter the purview of farm loans. We obviously follow all of them. And therefore the size and ticket size of the loan can vary from pretty small to pretty large, depending on the size of the farm and the crop involved.
Okay, so if I hear you right, you're saying we do have the capability of changing portfolio yields to account for, let's say, LGD in that portfolio. Maybe earlier we were factoring in just a diminution in value.
I didn't
No,
say
no,
that.
he did not say that. It just, Jimmy.
I was alluding to the differential ticket size that there could be and the wide range of farm products that therefore may be offered. We typically offer for most agricultural crops and the agricultural allied activities that are prevalent and permitted for us to finance. It is based on the scale of finance and it is based on a need-based requirement depending on the farm. There are also term loans given out to these people for developmental activities for those farms. So there are various products. There's a suite of products for this. The ability to adjust portfolio yields to react to LGD is not there to a very large extent because these are typically term loans and cash credit advances.
True.
So I didn't make any reference to flexibility on pricing midway through a transaction and should not be assumed.
Right. Okay. On the acquiring business?
Yeah, on the acquiring business, if you recall, around the time of demonetization, especially on the debit card side, the industry and the government had sort of agreed upon what will be the cap on the MDRs and what will be the cap on the issuance interchange. So effectively, for the first time, the debit card transactions became a bit positive, went into positive territory at that point in time. Now, ever since demonetization, the proportion of your debit card volumes have been increasing tremendously. Both, and we being one of the largest acquirers, we are also acquiring a large part of the debit card transactions. So since that proportion is moving up, the losses have been coming up. Have been coming off.
So it's a unit cost basically is coming down because of rising volumes.
Yeah, absolutely. Number one is, the starting point is the debit card is now having a positive spread. The mix of debit card volumes is increasing on the acquiring side. That's contributing to a declining losses over a period of time.
Right. Okay. And finally on that agri-commodity?
What exactly regarding the agri-commodity?
So I'm just wondering, if this agri-commodity would mean the trading part, the trading segment within MSME. Is that what you would allude to?
Processing and trading, yes. Most of the people who trade do some processing activity as well. So yes, this does refer to the processors and the traders. There are, again, we have products out for them.
See, let's face it, there were a couple of guargams and the soyas and a lot of these commodities where you have seen massive drop in commodity price.
Yes, so there have been commodity risks that has got involved there. There have also been certain pockets and certain markets where some of the practices have not been the best. We have called out those people. We have even reported some of them to the authorities as required. And we do have a fair insight now as to what requires to be done to select the good ones and deselect the bad ones. So there's a very large good and performing part to this portfolio as well. So rather than throw the baby out with the bathwater, there is some action behind it, and we do have insights on this.
Right. Do you think the portfolio quality is getting better in that segment?
Nilanjan, can we just allow, because I believe we just got a hint that a lot of other people are waiting for the questions. Can we come back to you after they finish?
Yep.
Thank you, Nilanjan. Thank you.
Thank you. Before we take the next question, I would like to remind participants, please limit your question to one per participant. You may come back in the question queue if you have a follow-up. Next question is from the line of Mona Ketan from Reliance Securities. Please go ahead.
Good evening, sir. On the business banking segment, just want to check, are you seeing any material improvement at the ground level? And secondly, were there any portfolio buyouts by the bank last quarter?
No, we have not bought any business banking portfolio, if that is what you're alluding to. No.
No, even on the retail banking side, if there were any buyouts.
No, other than home loans that we buy every quarter from HDFC Limited. And this time also we bought about 6,200 odd crores of loans from HDFC Limited. That's the only buyout that we buy from outside. So what is the second one? The ground level means the ground level feedback on business banking. What for? From what business?
Broadly on the asset quality perspective, are we seeing improvement at the business level for these SME entities?
It's a very wide spectrum once again. So you're talking across industries, across activities, you're talking across the service sector and trading as well. Mm-hmm. So are you talking about our portfolio?
Yeah.
Okay. So in our portfolio for business banking, we are seeing it in a relatively steady state now for some quarters. So we haven't seen anything significant. I didn't get a bigger detail from your question, so I wouldn't know what else to add to that. Are we seeing a deterioration? No.
Okay. Sure, that's all. Thank you.
Okay.
Thank you. Next question is from the line of Jatin K. from Alpha Capital. Please go ahead.
Hello, sir. Thanks for taking my question. My question is on the whole industry level and not just HDFC Bank. There are some news articles which says some of ILFS SPVs will not be able to pay up and some rating agencies have downgraded them. So how do you think that will impact the industry?
Sorry, can you repeat the question? I heard about ILFS. What is it?
As in there are some news articles which says some of ILFS special purpose vehicles, SPVs, they won't be able to pay up and they are being put into D by some rating agencies.
Right.
Earlier there were just holding companies only that was considered to be in trouble and SPVs were considered fine. So now these news articles are saying that these things also. So I was just wondering whether this will have an impact on the industry and how, as in if some of SPVs don't pay up, will this have an impact on the industry?
Frankly, industry, I'm not an expert on this one. As long as, you should be happy that HDFC Bank has virtually non-material, negligible or virtually zero exposures to that currently. Anyway.
Okay, that's it from my side. Thank you.
Thank you. Next question is from the line of Vibha Batra from Fair Connect. Please go ahead.
My question is on your exposure to NBFC and HFC. It's split into two in your disclosures for Basel III. It was broadly 57,000 crore as on March 2018. How much is it now? And what is your stance one on large housing finance companies, then middle-sized housing finance companies which are broadly less than 25,000 crore, and the retail NBFCs. This is for taking fresh exposures to these.
Just to
1 second. Yeah. Jimmy.
Fresh exposures to NBFCs and to housing companies. If you recall, this was asked last time as well, and we are cautious, but we are open to exposures on NBFCs. We do obviously look at parentage, we look at the portfolios, we look at the business models behind these portfolios, we look at the consistency of flows, we look at several things. I don't want to recount everything. But we are open.
So you're taking, okay, sorry.
That said, there hasn't been across the quarter any material change in the portfolios in the exposure. So there would have been some ins and some outs, but there's been no material change. Are we cautious? Yes, we are. Are we negative? Not particularly. We select.
Okay. And your cautious stance would arise out of more liquidity concerns. If you said you're possibly the vintage-wise the longest lender to the sector, and your own asset quality is excellent in that sub-segment as well. So when you say cautious, it comes from the environment or some other changes that you're looking at some of these NBFCs?
Naturally from the environment, and not necessarily due to incidents, but since even before incidents, we have obviously paid attention to the environments. But whether it is liquidity for some, portfolio for the others, consistency for others, it varies. We have an individual assessment in each and every case, so I wouldn't want to single out what exactly we are cautious about across the portfolio. It varies from case to case.
Okay. So you are taking selective fresh exposures.
It's selective, and selective is the word, yes. And it's not, to mention what you said about the quality, we don't have anything untoward.
And would it be safe to assume that you're way below your internal sectoral limits for both NBFCs and HFCs?
We are below. Way below is...
Will it be well below, like you'll have 20-25% cushion, or you're just about there?
I have headroom. I don't think I can give you numbers, but we have headroom.
Okay, thank you. Can I ask one more question, or should I come back in the queue?
There are a lot of people in queue, please. Can we first finish off with the others?
Yeah, thank you.
Thank you. Next question is from the line of Adarsh from Nomura. Please go ahead.
No, my question was answered. Thanks.
Thank you. Next question is from the line of Saurabh Kumar from JP Morgan. Please go ahead.
Sir, on your auto portfolio, how would the loan to value at origination, how would this have trended on the commercial vehicle and the car portfolio over the last 2 years?
It is stable. Once again, the loan to value ratio based on our policy moves within a range and a band. And that range and band obviously depends on the other attributes of the borrower in terms of the overall credit quality. But it's stable. We haven't made any changes.
But sir, for cars, it should be at around 90% levels today, or?
That would not be not so much in any significant. I wouldn't say we have done nothing at that level, but it's not the norm. It's low.
Okay.
It's low.
Okay. Okay. And for CV, sir, should it be between 65 to 70 or higher?
There's a wide range in CV because CV as a segment moves from the large fleet operator to a first-time user. So I'm not sure who you're referring to, but again within those, the LTV is one of the components that enters into the risk equation. Each case is underwritten or it is algorithmically underwritten and pre-approved, and therefore the LTV is just one of the ingredients that enters into the equation. There's a range.
Okay, got it. Thank you.
Thank you. Next question is from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi, Sachin. I just want to know what would be the debit card fees and credit card fees out of your total fees, and how much would they have grown over the last year or last few quarters as such? Because your loan book on credit card has been growing very fast. Should we expect a disproportionate rise in fees as well out there? Hello?
So I think, one second, let me just, okay. So the debit cards as a proportion of total is not even, is about 7%. Okay.
Of your total fees, total core fees.
Yeah, core fees. And your credit cards is roughly around 25-30%, yeah.
Okay, and has this number grown by a bigger proportion than your overall fees compared to last year? Or has it been, the proportion of fees have been going up in this segment? And is it a very big number change?
I would not say it is any significant change in the debit card, but the credit card, we are seeing a bit of a change in because we are market leaders there, and we are seeing a slightly high proportion of credit card fees happening. Yeah.
Okay, so you're saying 25 to 30% of the fees are from credit cards?
Yeah, both in the acquiring and the issuance side, both put together.
Okay. Okay. Thanks, Shashi. This was it.
Thank you.
Thank you. Next question is from the line of Mithun Soni from GC Ventures. Please go ahead.
Yeah, hello. Just want to understand, would you be able to share what would be our gross NPAs be excluding the agri part?
Sure. It is ex-agri, it is 1.1, roughly 1.1.
And what was it in the second quarter versus last year? Would you be able to share that?
So second quarter was 1.1, last year was also 1.1.
Perfect. And just to reconfirm, you said that 335 crores of contingency what you have made is you have made during the quarter.
Absolutely.
Okay, perfect. Thank you very much.
Thank you. Next question is from the line of Dhaval Gada from TSP Mutual Fund. Please go ahead.
Yeah, hi. Just one question. Could you reconcile the stock of floating provision at the end of the quarter? I remember you saying a similar number at the end of last quarter.
We've not added any to the previous quarter. It's roughly, I think, 1451 crores. It's okay. There, it should be there in the press release as well.
Oh, okay. And just one more question. Could you comment a little bit on the early bucket asset quality trends in the commercial vehicle portfolio over the last maybe 2-3 quarters, how that has been shaping up?
Let's see. Yeah.
Early bucket delinquencies across most retail assets are stable, and if anything in some portfolios actually a little better, but let's call it stable.
Okay, thanks.
Thank you. We take the next question from the line of Vibha Batra from FairConnect. Please go ahead. Vibha Batra from FairConnect, your line is unmuted. You may please go ahead.
Yeah, sorry. My question was on Index. Have you done the expected loss exercise on your various segments and on stage 1, stage 2, stage 3, if you were to provide what your facility lower or higher than what RBI provisions are?
No, you have to repeat the question. It's been very muffled, please.
I'm really sorry. So under Ind AS, you're supposed to provide for your loans basis expected loss approach.
That's right.
And it's supposed. So it's just trying to ask that if your provisions as per that approach, would they be higher or lower than your existing provisions which are...
So we have mentioned it in the past as well that the stage 1 and stage 3, there shouldn't be too much of a difference between whatever we are following in the Indian GAAP and the US GAAP. Stage 2, the only difference is, you have to, provide through the cycle. I mean, it is not on an annualized basis that you have to provide. So to that extent, the Ind AS stage 2 provisions, which is, in a very crude manner, the ones which are around the 30 DPD to the 89 DPD, I mean, I'm just giving a very crude range, will have a slightly elevated provisions than what it would be in the Indian GAAP. So even today, we have been providing floating provisions and general provisions. If you really look at it, the EL that is required on our standard portfolio is equivalent to or well within what we are carrying the floating and general provisions. So the only difference now is going to be that the stage 2, which we normally do EL on an annualized basis, we will now have to do only for that portion, will be on through the life cycle. So you will have to, if the average duration is about 3 years, then you have to multiply by 3, etc. So that will be the only change from our perspective on credit provisions.
So you're assuming that stage 1 provisions will be standard asset provision and you will not have to double provide for those?
Yeah, absolutely.
So there will be a favorable RBI regulation on that.
No, I mean, whether I'm not bothered about, see, ultimately, we'll have a certain stock when we migrate. I will be migrating principally into the pure Ind AS methodologies. So I'm not bothered about whether RBI will allow me to continue, etc. I know what it is. I'm just trying to say that on an apple-to-apple basis, where would the differences be?
Okay. Thank you.
Thank you.
Thank you. We take the next question from the line of Viral D from Anived Portfolio Managers. Please go ahead.
Hi, Sashi. I just had a question on the asset quality. Now, if I look at the GNPAs right now, they are at about 1.38. A lot of our growth recently has come from unsecured business banking. And we've seen a bit of movement on the business banking side. Plus, there continue to remain some challenges on the agri portfolio. So just wondering if this, ratio could deteriorate further. And is there a possibility of some pullback on growth on the agri portfolio?
So if you really look at, I think I just mentioned to someone just in the recent past that the gross NPL numbers, ex-agri has been pretty much stable through the year, right from last December to now. So it says that even though in absolute terms you may see a bit of a change or net addition to the gross NPL numbers, obviously the portfolios in the underlying respective products have also been increasing as well. So, obviously, we are in the business of commercial banking, taking risks, etc. It's not that it's going to be zero. I think this is well within, it's pretty much stable is itself is a big thing in this kind of an environment. Jimmy, you want to add something?
Yes, I just add that you alluded to the business banking and the unsecured. You use them in the same breath. So just to clarify, business banking is entirely secured.
Right.
Unsecured growth has been there, and that's been largely in the retail book. To a large extent, this is because unsecured products have lent themselves much better to new methods of assessment, and the underlying assets themselves have slowed down to create a market for asset-based debt. So that's where you would see the growth coming more in the unsecured. But the bulk of the unsecured growth is in the personal loan book, and that's holding up well.
I just want small clarification. The sales commission disclosure that you guys give on the P&L, is that on an accrual basis or a payout basis?
It's on an accrual basis.
Cool. Thank you. All the best.
Thank you.
Thank you. Well, ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to Mr. Jagdishan for his closing comments.
Thank you all for joining in on a Saturday evening. I know it's pretty late, but happy to take on anything later on. People can email to Bhavin or Srini or myself for any further queries. Thank you so much.